Can we finish on leverage and where we are in the cycle? This great line in your memo, the mother's milk of rapid expansion and speculation. If we reflect on the last, let's say, 10, 14 years, you would imagine that in a decade-long period of ultra-low interest rates, you would have had this explosion in leverage. There are several reasons for that. But this period's been quite odd because we then had the pandemic, which led to the strengthening of balance sheets for both corporates and households off the back of a monster fiscal transfer. And a question I think that Lisa and I hear a lot, Howard, is where is the leverage now? Where is the leverage now?
Well, we know that the leverage is in the government, that the government has taken on a lot of leverage as part of its rescue mechanism. We had two serious problems, the global financial crisis to kick off that low rate period you're talking about, and then the pandemic to bookend it. And in both cases, the Fed discovered something called quantitative easing, or the buying of bonds, and it really did a great job of saving the economy on both occasions, but it loaded up its balance sheet with debt. And you know, corporate balance sheets are generally okay. If you look at leverage buyouts, which is something that's very important to us, the leverage on those is lower than it historically has been. In the 90s, it was 70-75% debt, 25% equity in most companies. In the 80s, it was 95-5, and today it's more like 60-40. So the companies themselves are generally less levered.
Is it too simplistic to say if the increase in leverage has been on the sovereign balance sheet, that's where the risk is? How do you frame that? How do you think about that?
Well, first of all, I don't invest in sovereigns. And the trouble is that in sovereigns, other things matter. You know, they don't, when we look at companies, we ask, do they make money? Will they make money? Will they be able to pay their debt?
Yeah.
Governments don't make money. They're not expected to make money, and they pay their debt by running the printing press. So that's a very different function.
And then they have the ability of extending the cycle at the same time. I think this is what I'm trying to get my head around. If they've absorbed basically the leverage that existed elsewhere, and they are less exposed to the challenges of companies that you would invest in, are you thinking of a much longer cycle as a consequence?
Well, I don't think governments can keep us aloft forever, you know. And then the other question is, are the currencies acceptable to the world and at broad price? You know, an exchange rate is a price. The dollar-euro exchange rate is the amount of dollars that people will pay to get a euro. And if that goes off the rails, then maybe they can't print as much or have other indigenous problems. So again, multi-factor, not one.